A wonderful good morning, ladies and gentlemen, and welcome to NAGA and Markets for Breakfast. My name is Alex Duidari, and today it is Tuesday. It is January the 7th, 2020. We are pretty much in the early days of the first month of the year, so to speak. And obviously, with the situation between the US and Iran, a new variable to the whole market puzzle has come into play. And even though we can see that right now the impact has turned out to be limited, one has to ask the question, was that really it? And personally, I am not 100% sure. But let's have a look at, first of all, what we saw yesterday. Let's take a look at the S&P 500 first of all, just to get an idea what happened here. So we can see that actually there has been pretty much recovery mode going on in the US, and that's really the old basic pattern that we're seeing here. So the question is that can it really continue to persist like this? And even more so, you can see it in the Nasdaq that actually printed a positive on the day yesterday. Can you believe that? So, okay, it's not showing here in that chart so much, but it did actually. It went to positive, and something that's interesting here that we have been seeing is that markets, or the reason why markets are going up, some analysts are saying, like Lisa Abramovich is posting here from Bloomberg, is that the Fed cuts bets firmed on Iran tension. Just one easing is seen. So basically, the logic is that here, hey, if there's tensions between the U.S. and Iran, and the U.S. Has more struggle, more issues to fight, then the likelihood of the Fed needing to cut rates becomes higher. And there's different opinions, obviously. And for example, here we can read it's debatable whether additional Fed rate cuts can significantly prop up stock prices, as RBC's Lori Calvasina is saying. Actually, she said Calvasina said rate cuts would have the opposite effect and lead to stock decline. So who's right now? It's a pretty tricky situation. It's tough to say. What I can say is that it's becoming increasingly more reasonable to expect that this market how it behaved all in 2000, actually since the Trump election, excluded some dips here and there, if it really can continue like that, or if, for that matter, as we've seen the last 10 years. So the Fed will likely cut rates twice in 2020, helping to push the S&P above 3,500, is what Blackstone's Ween saying. So but he also saying, like, tech stocks will underperform. A millennial in NYC puts their phone down and makes eye contact with another human and finds it's not threatening and refreshing. That's interesting indeed. So that is kind of okay. So we are seeing that there are bets going on the market that are betting on that the Fed will actually proceed to a rate cut if the situation gets more problematic. And then we have another issue where we are not yet out of the woods, as they say, which is the deal, the phase one deal between China and the US. And yesterday, Donald Trump was further pushing to really have a date set for that, or confirm the date, which is supposed to be January 15th, which is in a week from now, right? It's next Wednesday. So that could be quite interesting, because what we see from the Global Times is that they are writing China US shouldn't rush phase one deal. A speedy signing is not of the essence, but the actual content of the deal and its implementation. So, wait a minute. Didn't we hear that the content of the deal was agreed on? Isn't that the purpose of actually proceeding to set a date for signing? And now we hear, I'd say voices of doubt. From where? From China. We all know Global Times is the representative voice of the Chinese government in media. So that will have some merit to it within the Chinese government. So, that would be interesting how that will continue, because here we read the business source: the China-U.S. Phase One trade deal is on track and could be signed in the near future. Sources told the Global Times on Tuesday. So, who are these sources? That's the question. Is it going to be signed? Should they not rush? What's going on here? It's, if anything, it's a little bit confusing and not 100% as it's supposed to be. And on top, we saw that actually yesterday the PMI out of China came in a little bit weaker. Not big, but a little bit. And given that the day yesterday was fully with PMIs, we talked about it yesterday in the morning on my call, it's that China has turned out to be the exception on positive PMIs here. So you can see that actually just China didn't come with a positive. Germany retail sales up massively. Services PMI out of Spain up, out of Italy up, out of France, okay, within expectation but strong at a 52. Germany services up. Services PMI for the Eurozone in total up, very good in fact. So that gives us pretty much a sign that there is some global stabilization going on. Even in the US, we saw that the market services PMI and composite came in stronger. So we see that there is you might call it a case of global growth stabilization. So even the US that had very bad ISM manufacturing on Friday, but I showed you that the market numbers were not so negative yesterday. Or there were diversion between how ISM was reading the data and how market was reading the data. So that was already then giving those negative numbers from Friday a little bit of a grain of salt, I would say. And now with these positive PMIs all over the place, you could argue that, hey, the global economy is on recovery. What do? We buy stock markets. Obviously, it's the only thing we can do. No, but joking aside, also JP Morgan saying that the improvements in services PMIs across the European region is positive. So it's actually the JP Morgan Global PMI Composite Index rose to an 8-month high. So all in all, the economy seem to have somewhat of a recovery now, showing also in the data. Just China, the China services PMI seems to be an exception to this positive trend, and also and this has impact. What impact does it have? Well, first of all, we also have the Australian dollar. The Australian dollar has been suffering. You can see that it's actually dropping more and more. And the negative China services PMI also pushes down the oceanic currencies, especially especially Australia, for the proximity with the Chinese economy, and also the situation with the fires in Australia are not really helpful for the case here of the very simple state. The central bank in Australia people say that it's going to cut rates this year, and the question was when. Most people agree on that it will, even though the sound of the central bank was sometimes tried to be more neutral. But with the fire, that has been, there needs to be billions and billions of Australian dollars for rebuilding the country, and the surplus of the country right now, the economic situation of the country right now, is not the focus of the government anymore, as Prime Minister Morrison stated yesterday. So that's why we could very likely expect a rate cut out of Australia to come sooner than later, and that combined with a weaker PMI out of China could really push the Aussie back into the trading range of the part 2 of the last year here, and we could see a drop below the 96 level as a confirmation in the coming trading session. So that's definitely something to look for here that has that makes sense, that could actually plan out. And we can see the same thing happen also in New Zealand, in sympathy with the Kiwi, with the Aussie, however a lot less strong. So the Australian dollar is likely to see more downside here than yeah, than the Kiwi, given that it's Australia that is burning. So hopefully they will get these fires under control sooner than later. But in general, what we can see is that the story in the market shifted from this Iran-led risk-off, right, and to now a story of the global economy is stabilizing, and that's really what we're seeing in the markets today. Even though we can see that gold, or actually gold yesterday, took a little bit of a hit, but it made it back because really, do you think that whatever happened here between US and Iran, that this was it? I'm not necessarily sure that this is the case, really. And that Iran, who knows what Iran is plotting? We don't know. And I don't like to think of them as the bad guys or the US as the good guys or the other way around. To me personally, they're all just actors on the scene, and I don't want to get into who's right, who's wrong. What I'm saying is that they have killed their main general military person of the country in a precise attack, and they are very likely to find some sort of a response to that. And how that response is going to look like, we don't know. But that's why I'm saying that. Just going back to the thinking that, hey, stock markets go up, rate cuts, that's just half of the glass, and you got to look at the other variables at play here. And it's like the fire in Australia. It's a variable. It's a new variable that wasn't really so present earlier, but now it's a very decisive one that it's likely to lead to rate cuts in the country, and that's why that has an impact on the currency there. And looking at oil, what we can see is that the oil price yesterday came down from its highs, and what's very, very interesting is that we can see that around that 64 area, maybe 62 to 64, we can see that we have now tried to push through that repeatedly. So which is here once after we came all the way down from 2018. Then into 2019, we failed for the first time below the 64 right here. And then the only other time that we got there was after the drone attacks on Saudi Arabia. So you can say it's a little bit of an artificially pushed price movement. As you can know, it was this huge gap here, and now for the third time we kind of do not get above that area. So what it tells me is that we need to see an escalation between the US and Iran for this price to really go above the 64. So 64 for me is that important level to watch that, in my opinion, can only be broken if there is some sort of a crisis getting tougher between US and Iran, and that will impact the oil supply. The OPEC Plus said that it will respond to any oil emergency from the crisis in Iran, but they also said spare capacity is tight. So that's what they want. That's what they want. This is a classical pushing the price higher. So if it really gets to some sort of a crisis between Iran and the US, then or like a military action, then the likelihood of the price of oil to go above the 64, and this is the WTI, the US oil, is high. I don't think it's going to go higher if there's no confrontation or war or anything comparable to that really happening. So that's also something to pay attention to. The price of gold, again, just because we looked at it, that we had some recovery here, I do think that gold continues to be relevant for anyone who wants to hedge against these geopolitical developments. The economy seems to be recovering, but again, we seeing massive amounts of liquidity put into the markets. And let me just pull up here. Where is he? Northman Trade. I know that's his website. I want to look at his Twitter. Okay, I have a couple of them here, as you can see. Here, this is what we're seeing. So yesterday alone, the Fed has put so much liquidity into the market, a lot more than on Friday. And even though the Fed says that they want to go out of the repo market in the mid of the month, I don't see how, and many analysts agree with that. So that means that the economy is the stock market is very much propped up by what's going on here. And you can see how Sven Henrik is reposting what Donald Trump has been posting years ago. So Q1 GDP has just revised down to 1.9%. The economy's in deep trouble. That was in 2012. Now a 1.9% to Donald Trump is the strongest economy in the world. Or here, Donald Trump in 2011, America's debt is greater than our GDP. Time for new thinking. Looks like Donald Trump did not adopt the new thinking. He's actually pushing it even more. So that tells you just like there's something inherently wrong, inherently not stable, in fact, in the US going on, and it can probably only continue to work if people continue to buy blindly and we continue to create some stability around it as much as possible, and it's been working very well. So here, this is an interesting chart. Ever lower rates encourage the taking on of ever more debt, which then can't be serviced with higher rates, requiring even lower rates, which then encourages the taking on even more debt. So what does it mean? It means that if we have low interest rates, then people take a lot of debt on it. Not just people, governments, companies, everyone, all right? So there's a lot of debt going on. This debt has an interest rate, right? Because debt needs to be paid back with interest. Now, if we increase the interest rate, it means that the cost for the already existing debt, not just talking about new debt, the already existing debt, goes higher. And the cost for this higher debt cannot be serviced anymore. People are not able to pay for it any longer because it's too much. And that's why we need to lower rates or actually go negative on rates, which then again encourages people, governments, companies to take on more debt. So that's why, we can see that this curve here, so the federal debt, public debt is going up, while the federal funds rate is going down. Okay, we had here very low rates, obviously, from 2010 to 15, and now it's going back down again. So that is the problem. Like in this phase here, they have acquired a lot of debt. And when this went up, this debt became extremely more expensive and hurting economies globally, not just the US. There's many emerging market countries that are in debt with US dollar currency. So that's an emerging market crisis. So actually raising interest rates could bring in a crisis globally. So that's why I don't think the dollar has a chance to really go higher on the interest rates by any chance. So looking at the calendar further today, what we see is that, and today is Tuesday, that we have retail sales out of Europe, out of Germany, that came in pretty good. CPI out of Europe. By the way, yesterday also out of the UK, let's have a look at the pound for a moment. We had, where is the UK PMI? A new car registration here. That came in at 50. So that's pretty much, it's not like expansionary yet, but it's very close to that. So 50 is the baseline. 50 means everything above 50 is good. Everything below is, So let's see how this will continue, but that's actually a good sign out of the UK. And looking at the currency per se, what we can see is that, first of all, the dollar index quite lower here, so the prospect of a rate cut in the US and also the good European PMIs have helped other currencies to gain against the US dollar. So that's why we saw especially the euro actually gain yesterday, and also the pound gained a little bit, even though we can see that now showing some weakness again, but it's still holding here well above the 130 level that we yesterday talked about. So that's a positive, and we could see a continuation towards the 132 possibly in the pound dollar. And in the euro dollar, where do we have it? Here it is. We can see that that 112 area was a rejection area for now, resistance, and we can see that's important because we were here same time in the middle of December. So, and it's right around that area that has been also a resistance between October and November. We're a little bit above it, so it can hold as a support now, which it didn't do in the beginning of the year, as you can see. So that's an important level now, the fight between the 112 and then actually reaching a new high, which is the 112.50. So that could be an interesting path for the euro over the course of the day. Other than that, what we can say is that looking at Bitcoin, we can see that this price is finally showing signs of really wanting to go higher, and we see that now we're struggling with or we actually pushed towards the 8K level. We just said almost hello to it, 7980. Now first recovery, and I could really think of that 8K to be retested now and possibly even taken, so that we find ourselves back in the trading range of October. So Bitcoin definitely continues to show bullish ambitions with this move. Finally, you have to say, after more than a month, in fact, just stuck here, and but we're anything but out of the woods yet, but it's looking quite constructive right now. And more important will be that we really see those highs here, 78, 79 taken out, and the 8,000 show on the daily close candle here. So that's my overview of the markets this morning. As always, thank you very much for listening in. I wish you a great successful trading day, and we'll be back here tomorrow morning. Bye bye.